On June 12, 2026, a rocket company raised $85.7 billion. That sentence alone should stop you. But here's what almost nobody is talking about. Less than 15% of that money has anything to do with rockets. The rest of it, the vast majority of it, is being funneled straight into semiconductors, into a $119 billion chip factory in rural Texas, into orbital data centers stacked with graphics processors, into a supply chain of tiny radio frequency chips that one company now ships out at a rate of 5 million units a day. Space exploration technologies, the company you know as SpaceX, just became one of the largest semiconductor buyers on the planet, and the ripple effects are already showing up in chip stocks from Taiwan to the United Kingdom. Today, we're breaking down exactly how a rocket company's stock listing is about to reshape the global chip trade, who the winners are, who's exposed, and why some of the smartest people in the industry think this could either be the next great infrastructure boom or a bubble with a familiar shape. To understand why this matters for chips, you first have to understand what actually happened on listing day. For over 2 decades, Elon Musk kept SpaceX private. His reasoning was simple. Wall Street's obsession with quarterly earnings does not mix well with a company trying to build reusable rockets on a multi-decade engineering timeline. That changed this year. SpaceX filed its initial paperwork with the Securities and Exchange Commission on May 20th, 2026, followed by an amended filing on June 3rd. Then, on June 12th, the company debuted on the Nasdaq under the ticker SPCX, in what stands as the largest initial public offering in financial history. The numbers are almost hard to process. 555,555,555 shares of Class A stock were offered at $135 each. That alone raised $75 billion. Add the fully exercised over-allotment option, and total fundraising hit $85.7 billion. By the end of day one, the stock had climbed 19%, and SpaceX's market capitalization crossed $2.1 trillion. 2 weeks later, it was sitting above $2.52 trillion. Musk kept control through a dual-class share structure. Class A shares, the ones the public bought, get 1 vote each. Class B shares, held mostly by leadership, get 10 votes each, and they retain the right to elect a majority of the board. After the offering, Musk personally controls roughly 82.4% of total voting power. Under Nasdaq's rules, that officially makes SpaceX a controlled company, which lets it skip a lot of the standard governance requirements public companies normally follow. And here's a detail that matters more than it sounds like it should. The Nasdaq changed its own rules on May 1st, 2026. Cutting the waiting period for index inclusion from 3 months down to just 15 trading days. That change let SpaceX join the Nasdaq 100 within 3 weeks of listing, which forced massive passive funds like Invesco QQQ, managing over $600 billion, to buy the stock automatically, whether their managers wanted to or not. So already, before we even get to chips, you can see the scale of capital in motion here. This is not a company raising a modest war chest. This is one of the largest single infusions of capital into one corporate structure in market history. Now the question becomes, where is that money actually going? Here's where it gets interesting, and here's where most coverage of this IPO completely misses the point. In February of 2026, months before the listing, SpaceX quietly completed an all-stock merger with xAI, Musk's artificial intelligence company. That merger folded in the Grok language model and the social platform X, and it valued the combined entity at $1.25 trillion. This wasn't a side deal. It fundamentally changed what SpaceX legally is. In its filing with the SEC, SpaceX classified itself under industry code 7370, computer programming and data processing, not aerospace. The filing states the company's total addressable market at $28.5 trillion, and 85% of that market, by SpaceX's own estimate, is artificial intelligence and cloud compute infrastructure. Only 15% is launch services and satellite communications. Read that again. A rocket company just told federal regulators in a legal filing that it considers itself primarily an AI and compute company. That reclassification lines up exactly with where the money is going. In the first quarter of 2026 alone, SpaceX's AI-related capital spending hit $7.7 billion, an annualized run rate of $30.8 billion. Compare that to $12.7 billion for the entire previous fiscal year. That's not incremental growth, that's a step change. Where is that spending landing? Two facilities in particular. Colossus 1 in Memphis, Tennessee, is already running roughly 100,000 Nvidia H100 graphics processors across 130 megawatts of power. Colossus 2 is scaling up further, targeting 110,000 GB200 chips and another 110,000 GB300 chips across 430 megawatts. The long-term roadmap calls for a combined 1 gigawatt of compute power across both sites. 1 gigawatt. That's roughly the output of a full-size nuclear reactor, dedicated entirely to running chips. Now let's talk about the part of this story that's easy to overlook, because it's not happening in a flashy data center. It's happening inside every single Starlink satellite SpaceX launches. SpaceX's Redmond, Washington facility now produces around 70 satellites a week. That production pace has done something structural to the economics of satellite manufacturing. Traditionally, the cost of a satellite split roughly evenly between the bus, the chassis, the power systems, propulsion, and the communications payload, which is where the chips live, 50-50. SpaceX's automation has crushed that ratio. The bus now makes up only about 30% of a satellite's value. The payload, the silicon-heavy part, is now 70%. In other words, Starlink satellites have become, first and foremost, chip products with a rocket-launched delivery mechanism attached. To hit that scale, SpaceX made a deliberate bet. Instead of using traditional radiation-hardened aerospace chips, which cost enormously more and are made in tiny volumes, SpaceX uses commercial, automotive-grade silicon and compensates for the lack of radiation hardening with redundant design, physical shielding, and software safeguards. That single decision is what turned satellite chip demand from a niche, low-volume business into a continuous, high-volume manufacturing cycle. The company at the center of this shift is STMicroelectronics. Their radio frequency chips go into the phased array antennas that let Starlink satellites and ground terminals track each other while moving. STMicroelectronics builds these using advanced BiCMOS technology and panel-level packaging, and their production rate now exceeds 5 million chips a day for this program alone. As of December 2025, they had shipped over 5 billion of these chips to SpaceX total. Their Starlink-related revenue has grown from $175 million in 2021 to $600 million in 2025, with a projected $1 billion in 2026 and a $3 billion cumulative target through 2028. Then there's Filtronic, a much smaller UK-based firm most people have never heard of. SpaceX needs extremely high-frequency amplifiers, operating in the 71 to 76 GHz and 81 to 86 GHz bands to link its satellite network back down to ground stations. Filtronic makes these using gallium arsenide and gallium nitride components. In 2024, SpaceX signed a £47.3 million supply deal with Filtronic. That single customer now accounts for roughly 83% of Filtronic's entire annual revenue. SpaceX even holds warrants to buy up to 10% of Filtronic's shares, vesting automatically as more orders come in, essentially locking the supplier in. This is the part of the story that matters most if you're watching chip stocks. It's not just Nvidia and the big American names benefiting here. It's small, specialized analog and radio frequency manufacturers in Europe that have quietly become dependent on a single customer's launch cadence. If the satellite story is about supply chain dependence, the next part of the story is about supply chain independence. This is the Terafab. Announced by Musk on March 21, 2026, the Terafab is a joint semiconductor semiconductor manufacturing venture between Tesla, SpaceX, and xAI, with Intel as the foundry partner providing the actual chip-making technology. The goal is a closed-loop facility that can design, fabricate, package, and test advanced chips all in one place, cutting these companies loose from dependence on Asian foundries. The scale involved is almost absurd. A prototype campus inside Giga Texas in Austin is running on roughly $20 to $25 billion of initial investment, targeting Intel's 14A process node. But the real project is planned for Grimes County, Texas, near the Gibbons Creek Reservoir, a facility that could eventually span up to 100 million square feet. That would make it 10 times larger than Giga Texas. Initial investment there is pegged at $55 billion, with total investment across all phases projected at up to $119 billion. On June 3, 2026, SpaceX locked in a 35-year, 100% property tax abatement from Grimes County in exchange for a $10 million upfront payment and $20 million annually. The project is expected to create 1,800 direct manufacturing jobs. To run it, Tesla and SpaceX hired Gary Zhang away from Intel, where he'd spent nearly 18 years, most recently running the factory that stood up Intel's 18A process node in Arizona. Intel formally joined the venture on April 7, 2026, licensing its 14A process, a 1.4 nanometer class node, to the project. The long-term target for Grimes County is 1 million wafer starts per month, producing everything from Tesla's custom AI5 inference chip, which taped out in April 2026, to memory and general-purpose graphics processors. The stated ultimate goal is 1 terawatt of AI compute hardware output per year. Whether or not you believe Tesla and SpaceX can actually stand up a leading-edge sub-2 nanometer class fab from a standing start, and plenty of engineers on forums like Reddit's chip design community are openly skeptical, the intent alone is enough to shift the competitive map. This is a direct challenge aimed at the traditional foundry order, at Taiwan's Semiconductor Manufacturing Company and Samsung, and it's happening on American soil, backed by trillions of dollars in fresh public capital. You'd expect a rocket company's IPO to just be a rocket company story. Instead, it briefly took down the entire semiconductor sector, then set it to a new record high, all within about 2 weeks. In the run-up to the listing, investors piled into proxy space stocks, Rocket Lab, Planet Labs, AST Space Mobile, trying to get exposure before SpaceX itself was tradable. The moment the listing priced, institutions dumped those proxies to fund their SpaceX allocations. At the same time, big tech and chip stocks got hit hard, as major holders sold down positions in names like Nvidia, Broadcom, and Marvell to free up cash. The Philadelphia Semiconductor Index dropped 10% on June 5th alone. Then the rebound. Once the offering was absorbed and a broader risk-on rally kicked in, helped along by a US-Iran peace framework and falling oil prices, sentiment flipped hard. SpaceX stock jumped another 19.6% on its second day of trading, closing at $192.50, with a market cap of $2.52 trillion. The Philadelphia Semiconductor Index rebounded 5.45% to an all-time high of 14,099.62, led by memory and storage names. Western Digital jumped 16.1%, Micron rose 10.84%, Seagate gained 9.43%, Taiwan Semiconductor climbed 4%, Nvidia rose 3.54%. The read from the market was clear. Investors are betting that space-based compute and terafab-scale manufacturing are going to require an enormous amount of premium memory and logic, and they're pricing that demand in now, well ahead of any of it actually shipping. Not everyone agrees on what any of this actually means. Goldman Sachs, one of the lead underwriters, projects SpaceX's total revenue could grow from $18.7 billion in 2025 to roughly $474 billion by 2030, a 90% compound annual growth rate, with the space-based AI division alone growing from $3.2 billion to $322 billion over that same window. The bull case is essentially, this is Amazon in 1997, and the capital expenditure you're seeing now is buying a future monopoly. Morningstar disagrees sharply. Their analysts put SpaceX's fair value closer to $780 billion, a 65% discount to where it's currently trading, arguing the valuation rests on unproven revenue streams like orbital computing that face serious physical hurdles. And those hurdles are real. Cooling high-performance chips in a vacuum is a genuinely hard problem. Bigger radiators mean more mass and more surface area, which means more exposure to orbital debris, solar flares, and cosmic radiation that can flip bits inside dense transistor structures. There's also a historical echo worth sitting with. In the late 1990s, telecom companies borrowed enormous sums to lay fiber optic cable across the globe, betting that internet demand would justify it. Then a technology called dense wave division multiplexing let existing fiber carry 100 times more data than before. Supply outran demand, and companies like WorldCom, Global Crossing, and Nortel collapsed. Only about 3% of installed fiber was even active at the peak of the bust. But the physical fiber stayed in the ground, and a decade later, streaming and smartphones caught up and lit it all. The difference this time, analysts point out, is funding structure. The 1990s telecom boom ran on speculative debt. Today's build-out is backed by cash-rich companies with far lower leverage. But there's a second difference that cuts the other way. Buried fiber lasts for decades. High-performance graphics processors have a competitive lifespan of maybe 3 to 5 years before newer chips replace them. If orbital compute demand doesn't show up on schedule, the hardware sitting in space doesn't get to wait around for the market to catch up like fiber did. It just becomes expensive, orbiting scrap. There's also a hard geopolitical wall around all of this. Because SpaceX's rockets fall under U.S. arms export regulations, the underwriting banks were required to block all investment bids from mainland China and Hong Kong during the IPO roadshow. Attempts to even access the IPO website from those regions returned an error message. That same regulatory pressure, combined with December 2024 rules restricting foreign access to high-bandwidth memory and advanced logic tools, is a direct part of why SpaceX is building the terafab domestically instead of outsourcing it. National security isn't a footnote here. It's one of the core reasons this entire chip strategy exists in its current form. So here's the question this leaves us with. But there's something worth sitting with that I haven't said yet. Every piece of this, the orbital compute, the terafab, the satellite silicon boom, depends on one assumption holding true, that demand for AI compute keeps climbing at the pace these companies are betting on. If that assumption breaks, this becomes the most expensive infrastructure bet in history sitting unused, the same way dark fiber once did. If you want to understand how that same compute race is playing out on the other side of the world, in Taiwan, in China, and across South Asia's own path into the chip supply chain, that's exactly what I break down in this next video. Go check it out, and I'll see you there.